Okay, real talk. You've done everything right. You've got your 401k. Maybe you've got a little money sitting in a high-yield savings account earning, like 4.5%. You're putting a few $100 a month into index funds. And you feel pretty good about yourself until you read some article about how a family worth $50 million structured their estate, and you realize you have absolutely no idea what you're looking at. They're talking about things like Dynasty trusts and private placement life insurance and opportunity zone funds. And you're sitting there thinking, what is that? Why have I never heard of this? And more importantly, is this something I should be doing? Here's the thing. The reason you've never heard of it isn't because it doesn't apply to you. It's because nobody's explaining it in a way that actually makes sense. That changes today. My name is Shyam, and I spend way too much time thinking about where wealthy families actually keep their money and why the rest of us are never taught any of it. If you're someone who feels like you're doing everything the financial advice books tell you to do, but you still feel like you're missing a piece of the puzzle that the ultra-wealthy figured out a long time ago, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today we're going through 5 places where genuinely wealthy families store and grow their money, places that most financial influencers don't talk about, either because they don't fully understand them or because, honestly, they're not that exciting to explain. But they are powerful. And by the end of this video, you're going to understand not just what they are, but why they work mathematically and psychologically. Let's get into it. Before we get to the 5 places, I need to set the stage with one idea, because without it, none of this makes sense. Most of us are taught to think about money in terms of returns. How much did my investment grow? Did I beat the S&P 500? Is my savings account rate high enough? Wealthy families think about money in terms of what they get to keep. Look, there's a massive difference between a 10% return where you keep all of it and a 14% return where the government takes 37% of it. And here's what most people don't realize. The ultra-wealthy have spent generations figuring out how to legally maximize what they keep. Not through shady offshore schemes, through structures, through vehicles, through places most people have never even considered putting their money. The Federal Reserve Survey of Consumer Finances found that the top 1% of wealth holders own roughly 38% of all 8 financial assets in the United States. And a disproportionate amount of that isn't in regular brokerage accounts. It's in vehicles specifically designed to minimize taxes, protect assets, and compound over decades, sometimes centuries. So when we talk about obscure places, we're not talking about hiding money under a mattress in the Cayman Islands. We're talking about completely legal, IRS-recognized structures that most financial advisors either don't bring up or don't fully understand themselves. All right, let's go through them. I know what you're thinking. You clicked on a video about obscure wealth-building strategies, and the first thing I'm going to talk about is life insurance. Stick with me, because this is not what you think it is. Most people understand life insurance as a death benefit. You die, your family gets a check, and sure, that's part of it. But wealthy families have been using permanent life insurance for something entirely different for over 100 years, as a tax-advantaged savings and lending vehicle. Here's how it works. With a properly structured whole life, or indexed universal life policy, often called IUL, you pay premiums into the UL policy, and a portion of that builds up as what's called cash value. This cash value grows on a tax-deferred basis. So far, not that different from a Roth IRA. But here's where it gets really interesting. You can borrow against that cash value, and those loans are not considered taxable income by the IRS. So let's say you've got $300,000 in cash value built up in your policy over 20 years. You borrow $150,000 against it. You don't pay taxes on that $150,000. You can use it to invest in real estate, start a business, bridge a gap, whatever you need. Meanwhile, your full $300,000 is still sitting there earning interest because the loan isn't actually a withdrawal. Now, if you do this poorly, if you buy an off-the-shelf whole life policy from an agent who's just chasing commissions, you're going to get a terrible deal. The fees will eat you alive and the returns will be embarrassing. But when these policies are specifically designed and overfunded for cash value accumulation, and this is what wealthy families do, the math actually becomes surprisingly competitive. A study by McKinsey found that high net worth families increasingly use permanent life insurance not for the death benefit, but as a tax-advantaged asset class in its own right. And the reason is simple: tax-free growth, tax-free access, and it passes to heirs outside of probate. Nelson Rockefeller, Walt Disney, Ray Kroc. These people used life insurance as a banking vehicle long before index funds were a thing. Now, is this for everyone? No. You need income, and you need to be working with someone who actually knows how to structure these correctly. But if you've maxed out your Roth IRA and your 401k, and you're looking for the next tax-advantaged bucket, this deserves a serious look. Place #2 Dynasty Trusts. This one is wild to me, because once you understand it, you can't stop thinking about it. A dynasty trust is essentially a trust designed to last, not for your lifetime, but for multiple generations. In some states like South Dakota and Nevada, a dynasty trust can theoretically last forever, and the assets inside it can compound across generations without being subject to estate taxes at each generational transfer. Here's the math on why this matters so much. Let's say your grandparents put $1 million into a dynasty trust in 1970 and invested it in a diversified portfolio, returning an average of 8% annually. Without a trust, each time that wealth transferred to a new generation from grandparent to parent, parent to child, it would face estate taxes of up to 40% on amounts above the exemption threshold. That 40% haircut, compounding across 2 or 3 generational transfers, is genuinely devastating to long-term wealth. With a dynasty trust structured correctly, those transfers can happen without triggering estate taxes. The $1 million from 1,970 at 8% annually would be worth roughly $85 million today. But if that family had paid a 40% estate tax at just 2 generational transfers, you're looking at less than $30 million. That's a $55 million difference from one structure. Now you might be thinking, okay, Nick, I don't have $1 million to put in a trust right now. And that's fair, but here's the thing. The time to learn about these structures is before you need them, not after. Understanding dynasty trusts changes how you think about building wealth entirely. You stop thinking about your wealth as something that ends with you and start building differently. States like South Dakota, Nevada, and Delaware are considered the most favorable for dynasty trusts because they have no state income tax on trust assets, strong asset protection laws, and favorable perpetuity rules. If you're working with an estate attorney and they haven't brought this up, ask about it. Seriously. Place #3, Opportunity Zone Funds. Okay, this one came out of the 2017 Tax Cuts and Jobs Act, and I still think it's one of the most underutilized wealth-building mechanisms available to regular investors, not just ultra-wealthy families. Here's the concept. The federal government designated roughly 700 census tracts across the country as opportunity zones, areas that are considered economically distressed and in need of investment. To incentivize private investment into these areas, they created a remarkable set of tax benefits for anyone who invests capital gains into an opportunity zone fund. Let me give you a real example with numbers, because this is where it gets genuinely impressive. Let's say you sell some stock and you have $100,000 in capital gains. Normally, you'd owe somewhere between 15% and 8% in federal capital gains taxes. So, roughly $15,000 to $24,000 gone immediately. But if you reinvest those gains into a qualified opportunity zone fund within 180 days, you defer that tax. You don't pay it now. But that's just the beginning. If you hold that investment for at least 10 years, any new gains generated by the opportunity zone investment itself are completely tax-free. Zero, not deferred, eliminated. So that $100,000 that, in a normal investment scenario, might grow to $350,000 over 20 years. And you'd owe capital gains tax on $250,000 of gains in an opportunity zone fund. That entire $350,000 could be yours tax-free. Now, here's the honest caveat. Opportunity zone funds invest in real estate development and operating businesses in specific geographic areas. The quality of these funds varies wildly. There are some genuinely excellent ones, and some, that are essentially ways for developers to get cheap capital on bad projects. You have to do due diligence, but wealthy families have been quietly flowing capital gains into well-managed OZ funds for years, and the tax math is almost impossible to argue with. This is actually an area where you don't have to be ultra-wealthy to participate. Many OZ funds have minimums of $25,000 to $50,000, which makes them accessible to a much wider range of investors than most people realize. Place #4 Private Placement Life Insurance, PPLI. All right, now we're getting into territory that's genuinely more exclusive, but you need to know it exists. Private Placement Life Insurance, or PPLI, is essentially a combination of the life insurance concept we talked about in Point Hasson and a private investment fund. And it's one of the most powerful tax structures in existence for high net worth families. Here's the basic concept. You set up a life insurance policy typically requiring at least $1 to $2 million in minimum investment. Inside that policy, instead of investing in a standard fixed or indexed account, you invest in private funds, hedge funds, private equity, private credit asset classes that are normally incredibly tax inefficient. Think about hedge funds for a second. A typical hedge fund might generate 15–20% returns, but it also generates significant short-term capital gains and ordinary income from frequent trading. In a regular taxable account, you're getting taxed every single year on those gains. At high income levels, that's 37% ordinary income tax plus state taxes. The after-tax return gets absolutely crushed. Inside a PPLI structure, those same assets grow tax-deferred, and if designed correctly, the death benefit provides tax-free access to the heirs. Suddenly, that hedge fund generating 15% gross returns is actually keeping much more of that 15%, compounding across decades. A Bloomberg analysis estimated that a family investing $10 million into a PPLI structure versus a standard taxable account could retain 3 to 4 times more wealth over a 30-year period from taxes alone. That's not investment performance. That's purely structure. Now look, PPLI is genuinely for people with significant capital. The regulatory and legal complexity is real, and you need serious advisors to set this up correctly. But the reason I'm telling you about it is this. Understanding that this exists should fundamentally shift how you think about tax efficiency at every level of wealth, because the principles apply whether you have $10 million or $10,000. Tax drag is the silent killer of compounding, and the wealthy figured that out a long time ago. Place #5 Family Limited Partnerships, FLPs, and LLCs, used for generational wealth transfer. This last one is my favorite because it's the most actionable for the widest range of people, and it's something you can start thinking about even before you're wealthy. By conventional standards, a family limited partnership, or its cousin, the family LLC, is a legal entity that allows a family to pool assets together under one structure, with different family members holding different percentages of ownership. Here's why wealthy families love this. First, valuation discounts. When you put assets into an FLP, say, the real estate or a portfolio of investments, and you start gifting limited partnership interests to your children or grandchildren, those interests can be valued at a discount to the underlying asset value. Why? Because a minority interest in a limited partnership is less liquid and carries fewer control rights than outright ownership of the asset. The IRS acknowledges this. Courts have upheld it. Valuation discounts of 20% to 40% are commonly accepted. What that means in practical terms, if you have $1 million in real estate held in an FLP and you want to gift a 20% interest to your child, that 20% interest, representing $200, 000 of underlying value, might be valued at $130,000 to $150,000 for gift tax purposes. You've effectively transferred $200,000 of wealth while only using $130,000 to $150, 000 of your lifetime gift tax exemption. Do that systematically over years and decades, and you can transfer enormous amounts of wealth with dramatically reduced tax exposure. Second, asset protection. Assets inside a properly structured FLP or family LLC are much harder for creditors to reach. For business owners, professionals with liability exposure, or anyone concerned about lawsuits. This matters enormously. Third, control. Here's what most people don't realize about why wealthy families use FLPs that goes beyond the tax stuff it's about. Governance. The senior generation typically retains control as the general partner while gifting limited partnership interests. You can transfer economic value to the next generation while still controlling how the assets are invested and managed. For families with operating businesses or significant real estate portfolios, this is absolutely critical. The cost to set up a family LLC or limited partnership is a few $1,000s in legal fees. That's it. For families building real estate portfolios, business owners, or anyone accumulating significant assets, this is not a someday when I'm wealthy structure. This is something to think about now, before you need it. Here's something I want you to sit with for a second, because I think it's the most important takeaway from this entire video. None of these 5 things are secret because they're illegal. They're obscure because learning about them requires getting out of the normal consumer financial media ecosystem and ecosystem that profits from keeping you focused on product choices, which brokerage, which ETF, rather than structural choices. How is this thing set up? What entity holds this? How does it transfer? There's a concept in behavioral finance called complexity aversion, the human tendency to avoid things we don't understand, even when those things would benefit us enormously. Wealthy families don't have the luxury of complexity aversion because the advisors they work with won't let them. They're forced to engage with the complexity. Most of us don't have advisors like that, which means we have to seek the knowledge ourselves. And that's why you're here, and that's why this matters. The gap between the wealthy and everyone else isn't just about income. It's not just about investment returns. It's about structure. It's about who controls the complexity and who gets controlled by it. Look, I don't want you walking away from this video feeling overwhelmed, so let me give you something concrete. If you're early in your wealth building journey, focus on understanding the concepts here, not implementing them right now. The goal is to be ready when the opportunity arrives. Start with a term life policy if you don't have coverage, and research what a properly structured whole life policy looks like versus a poorly designed one. Read about opportunity zones. Understand what a family LLC is. Plant seeds. If you have accumulated some meaningful assets, real estate, a business, a portfolio with significant unrealized gains, I want you to schedule a meeting with an estate planning attorney in the next 90 days. Not a financial planner, an estate planning attorney. Ask them specifically about family LLC structures and dynasty trusts. If they can't speak fluently about both, find someone else. If you're a business owner, generating capital gains, learn about opportunity zone funds. Find 2 or 3 reputable fund managers. Look at their track records. Understand the specific projects they invest in. This is not theoretical. This is a real tool available to you right now. Here's what I want you to remember. The wealthiest families in this country aren't just better at picking stocks. They think about money differently, at a fundamental level, not just where to put it, but how it's held, how it transfers, and how much of it they actually keep. Understanding these 5 places: permanent life insurance used as a banking vehicle, dynasty trusts, opportunity zone funds, private placement life insurance, and family limited partnerships, is about developing that mindset. It's about realizing that the structure of wealth matters as much as the accumulation of wealth. And here's the most encouraging thing I can tell you. Every single one of these structures was invented and is used by people who, at some point, didn't know it existed. They learned. They built the team. They implemented. And the compounding effect of getting these things right shows up not over quarters but over decades. You now know these exist. That puts you further ahead than you were 15 minutes ago. Use it. If this video gave you something valuable, even one idea that made you think differently, hit the like button, subscribe if you haven't yet, and drop a comment below telling me which of these 5 you'd never heard of before. I read every single one. I'll see you in the next one.